$6,000. That is the number sitting on the table right now, and most retirees are going to walk right past it. If you are married and both of you are 65, the number doubles to $12,000. This is a brand new deduction written into the tax law signed in July of 2025, the One Big Beautiful Bill Act. It landed quietly. No confetti, no big mailer from the IRS explaining it to you in plain English. It just showed up in the code, worth real money, and set to vanish after 2028. Here's what almost nobody tells you. The people most likely to miss it are the ones who heard the phrase "no tax on Social Security" and assumed they were covered. It did not. Let me show you exactly what this is. So here's a direct question. Consider what a deduction is actually worth in dollars, not in theory. For a retiree in the 12% bracket, a $6,000 deduction is worth about $720 back in the bank. Move up to the 22% bracket, and that same deduction is worth roughly $1,300. For a married couple stacking the full $12,000, that is real money year after year for 4 straight years. Now here's the part that stings. This deduction does not show up unless someone claims it correctly on the return. The IRS is not going to call the house. Tax software only catches it when the information is entered right. Miss the age box, skip the Social Security number, file the wrong status, and the whole thing evaporates. Think about that for a second. A benefit worth thousands, gone because of a checkbox. That is the cost of not paying attention here. So stay with me to the end because there is a trap buried inside this deduction. One that catches the exact people who think they are safe. It phases out right where a lot of middle-income retirees live. And it disappears on a timer most people have not marked on any calendar. I am going to walk you through what it is, who actually qualifies, and how to capture every dollar before the window closes. The last part is the part almost nobody plans for. Let's start with what this thing actually is. Act 1. The tax law signed in July of 2025 created a new temporary deduction for people 65 and older. The IRS calls it the enhanced deduction for seniors. Most people are calling it the senior bonus deduction. The amount is $6,000 for each qualifying individual who is 65 or older. If you are married filing jointly and both spouses are 65, you each get your own $6,000, which stacks to $12,000 on one return. That figure comes straight from irs.gov on their eligibility page published in 2025. So this is not a rumor from a forum, it is in the code. Now here is the feature that makes this genuinely different. This deduction applies whether a filer takes the standard deduction or itemizes. Read that again. Most deductions force a choice. You either itemize your mortgage interest and charity, or you take the standard deduction and you pick whichever is bigger. This new senior deduction sits outside that fight. It rides on top. Fidelity, in their 2025 explainer, put it plainly. It is available whether you claim the standard deduction or itemize. Think of it like a coupon that works even when you are already using the store sale. It does not care which line you are standing in. That is rare, and it is why this one is worth understanding. And it stacks. This is where retirees start to underestimate it. There is already an extra standard deduction for people 65 and up, and it has existed for years. That did not go away. This new $6,000 deduction is a third layer on top of it. Let me give you the actual numbers for a single filer in 2026. The base standard deduction is about $16,100. The existing age 65 add-on is about $2,050. Then the new senior bonus adds $6,000 more. Stack them, and you sit near $24,150, all deductible before you owe a nickel. That example comes from Kiplinger's 2025 breakdown. Picture 3 envelopes of cash, not one. Most people only ever knew about the first envelope. Let me put a real married couple on the table so the $12,000 stops being abstract. Picture Frank and Rita, both 67, both retired, filing jointly in 2026. Their base standard deduction as a couple is around $32,300. The existing 65 and up add-on gives them roughly another $3,200 combined. Now, the new senior bonus stacks $12,000 more on top. Add it up and they clear more than $47,000 in deductions before a single dollar of their income is taxed. A few years ago, that same couple would have started at around 30,000. The law just handed them a materially bigger shield, and the 12,000 piece of it is brand new and temporary. That is the difference between a good retirement tax year and a great one. Here is a small aside that matters. The politicians sold this as no tax on Social Security. That phrase did a lot of heavy lifting in the press. What actually got written into law was this deduction. It is not the same thing, and I will come back to why that distinction can cost you. For now, just hold on to the real mechanic. It is a deduction against your taxable income, not a magic switch that turns your benefits tax-free. The number is real. The label was marketing, and the difference is where the money hides. So that is what it is. A $6,000 deduction per senior, $12,000 for a qualifying couple. Good on top of everything else you already claim. But a deduction is only yours if you qualify for it. And qualifying is where this gets sharp. Act 2. Who actually gets to keep this money? 3 rules decide it, and each one quietly disqualifies people who assumed they were fine. Rule 1 is age. You must be 65 by the end of the tax year. Not 65 and a half, not 65 sometime next spring. 65 by December 31st of the year you are claiming. If you turn 65 on January 2nd, you wait a full year. It is a hard line, and the calendar does not negotiate. Rule 2 is the Social Security number, and this one trips people up in ways they never see coming. To claim the deduction, the qualifying individual's Social Security number has to be on the return. If you are married and both of you want to claim your $6,000 each, both Social Security numbers need to be there and valid. This was written in on purpose. It is not a suggestion. Kiplinger and the IRS both spell it out. Think of it as the bouncer at the door checking IDs. No valid number, no entry, no matter how old you are. Rule 3 is filing status. And this is the one that catches married couples flat. If you are married, you have to file jointly to claim this deduction. File separately and you lose it. Some couples file separately for reasons that made sense for them. Income-driven student loan math, legal separation, keeping finances apart. If that is you, understand the trade. Filing separately here can cost you up to $12,000 in deductions. Run the numbers before you split the return. Let me be honest, that is a decision worth an hour with a calculator because the wrong choice is expensive and completely avoidable. Now the part I promised. The phase-out. This is the income cliff, and it is where middle-income retirees get quietly pushed off the ledge. The full deduction is available up to a modified adjusted gross income of $75,000 if you are single, and $150,000 if you are married filing jointly. Below those lines, the whole deduction is available. Above them, it starts shrinking. Those thresholds come directly from the IRS eligibility page and Fidelity's 2025 write-up. Picture a staircase that only goes down once you cross a marked step. Here is exactly how fast it shrinks. For every $1,000 of income over the threshold, you lose $60 of deduction. That is 6%. Fidelity described it in plain terms. For each $1,000 above the line, the deduction drops by 60. So a single filer at $85,000, $10,000 over the line, loses $600 of the deduction. Keep climbing, and it keeps bleeding. It does not fall off a cliff all at once. It leaks steadily the higher your income goes. Think of a slow puncture in a tire, not a blowout. Let me run the ramp with real numbers so the leak is visible. A single retiree right at $75,000 keeps the full $6,000. At $100,000, $25,000 over the line, the deduction has shrunk by $1,500 down to $4,500. At $125,000, half of it is gone. At $150,000, only $1,500 of the deduction survives. Every step up the income ladder shaves another $60 per $1,000 off the top. The benefit does not slam shut. It thins quietly in a range where a lot of comfortable retirees actually live. That is what makes the phase-out sneaky. Most people getting clipped have no idea it is happening, and then it hits zero. For a single filer, the deduction is completely gone once your income reaches about $175,000. For a married couple filing jointly, it is fully gone around $250,000. Those endpoints are confirmed in the 2025 Kiplinger and Fidelity breakdowns. So the whole benefit lives inside a band. Under the floor, you get all of it. Over the ceiling, you get nothing. In between, you get a slice that gets thinner every $1,000 up. Here's what almost nobody tells you. A one-time bump in income, a big Roth conversion, a capital gain from selling a rental, can shove you up that ramp and shrink a deduction you assumed was locked in. The number on your 1040 is not fixed. You have levers. That is the whole game, and it is what Act 3 is about. Act 3. How you actually capture this dollar for dollar. Because knowing the rule is not the same as keeping the money. The first lever is timing your income. Your eligibility is decided by your modified adjusted gross income in each specific year, 2025, 2026, 2027, 2028. That means the goal is to keep your income under or reasonably near those phase-out thresholds in the years you want the full deduction. If income timing is in your control, so is how much of this deduction survives. A retiree who can choose whether to pull from a taxable account or a Roth has a steering wheel that a working person rarely gets. Use it. Here's a concrete move. Roth conversions. Converting money from a traditional IRA to a Roth adds to your income in the year you do it. Normally that is fine. Even smart because you pay tax now at a known rate and never again. But watch the interaction. A large conversion in 2026 could lift your MAGI over the phase-out line and quietly erase part of your senior deduction in that very same year. So the play is to size the conversion to the threshold, not blow past it. Fill the room up to the line, then stop. Think of it like pouring coffee into a cup you have to carry across a room. Fill it to the top and you lose some on the walk. Leave a little space and you keep it all. Small aside, this is exactly the kind of thing good tax software misses unless you model it on purpose. Here is the timing math laid out. Say a single retiree sits at $60,000 of income and has room before the $75,000 line. That is $15,000 of headroom for a Roth conversion, one that still leaves the full senior deduction intact. Convert $15,000, pay the tax at today's known rate, and the $6,000 deduction stays whole. Push the conversion to $30,000 instead, and the last $15,000 of it climbs over the line and starts eating the deduction at $60 per thousand. Same person, same account, two very different outcomes based purely on the size of one move. This is a spreadsheet decision, not a gut decision. An afternoon of modeling can be worth $1,000 or more. The second lever is coordination. Remember, this deduction stacks on the existing 65 and up standard deduction and the base standard deduction. So the retirees who win are the ones who look at all three layers together, not one at a time. For a single retiree whose total deductions already push past $24,000, a chunk of retirement income comes out completely untaxed. That changes how much they can convert, how much they can withdraw, and how much Social Security actually gets taxed underneath it all. It is not one thing. It is the stack working together, and you have to see the whole stack to use it. And now the lever that matters most, because it has an expiration date stamped on it. The sunset. This deduction is written to apply to tax years 2025 through 2028, and then it ends. Unless Congress renews it, 2028 is the last year you can claim it. The IRS page and every major explainer say the same thing. It is temporary. Think about what that means. You do not have forever to plan around this. You have 4 tax years and one of them is already half gone, as you listen to this in the middle of 2025. Circle 2028 on the calendar in red. After that, the third envelope is empty. That deadline is the whole reason this video exists, and it is the piece almost nobody has priced into their plan. There is one more practical wrinkle worth naming. The 2025 tax year is the first year this applies, and for most people, it will be handled on the return filed in early 2026. So the very first chance to claim it is the return sitting on the desk this coming filing season. A retiree who overlooks it there does not just lose 1 year of the deduction. They set a pattern because the same blind spot tends to repeat every April until the benefit is gone. The fix is boring and effective. Confirm the age box is checked, confirm every qualifying Social Security number is on the return, confirm the filing status is joint if married, and confirm the modified adjusted gross income sits where the full deduction survives. 4 checks, 4 years, real money each time. That is the entire discipline this rule asks for. So let's be honest about the limits. This deduction is not a gift to everyone, and pretending otherwise would waste your time. A high-income retiree above 175,000 single or 250,000 married gets exactly nothing from this. Zero. It was designed to skip the top earners, and it does. If your income lives in that range, do not build a single plan around a deduction you cannot claim. Second honest point. It is temporary. 4 years, then it is scheduled to disappear. Do not treat a benefit that sunsets in 2028 like it is a permanent feature of your retirement. It is a window, not a fixture. Building a decade-long plan around a 4-year rule is how people get surprised. And third, the big one. This is not no tax on Social Security. That phrase was the sales pitch. The reality is a deduction that lowers taxable income, which can, indirectly, reduce the tax owed on benefits. But Social Security is not suddenly tax-free, and a retiree who assumed it was might be under withholding right now. Fidelity said it carefully. It can lower the tax you owe, though not directly on your total income. Believe the mechanic, not the marketing. Which brings me to the twist, and this is the part I really want you to hold on to. A temporary deduction is not a gift. It is a timing window. Read that difference slowly. A gift is something you receive no matter what you do. A window is something you have to move through before it shuts. The retirees who win here are not the ones who are simply eligible. They are the ones who deliberately move income into the 2025 through 2028 window because they know the door closes after that. Here's the quotable line. A deduction with an expiration date is not a break, it is a deadline in disguise. Think about that for a second. The whole thing rewards action, not eligibility. Two people can qualify identically. One does nothing and takes whatever falls out. The other pulls conversions forward, times withdrawals, keeps income under the line in the right years, and walks away with thousands more. Same rule, same age, wildly different results. The difference was never the deduction. It was the timing. And timing is the one thing you actually control. Let me leave you with two retirees. Both turned 65 in 2025. Both single, both with about the same nest egg. The first one heard senior deduction, assumed it was automatic, and never thought about it again. She kept her income wherever it landed, took a big IRA distribution in 2026 that pushed her over the phase-out line, and quietly lost most of the benefit 2 years running. The second one marked 2028 on the calendar the day she heard about this. She sized her withdrawals to stay under 75,000, ran her Roth conversions right up to the line, and captured the full 6,000 every year the window was open. 4 years later, sitting on the same porch, one of them had kept several $1,000s more than the other. Not because she earned more, because she noticed the number on the table and reached for it. That $6,000 we started with, it was always there. The only question was who bothered to pick it up. If this made the tax code a little less foggy, subscribe and stick around. The next number you are missing might be bigger.